Welcome. Today we'll be going over 5 undervalued dividend stocks for August 2024. Now I do want you to keep in mind that I try to show you as many firms as I can, and I don't want to repeat the obvious ones such as Nike or Starbucks in a lot of these videos, which is why I try to cover new stocks even if they might not be at 52-week lows. So let's jump straight into it. At number 1, we have Louis Vuitton Moët Hennessy, which is LVMH, the giant from Europe, which is down over 21% in this past year. However, the luxury industry has dropped since then, with sales in China actually slowing and declining in the previous quarter. Now, one thing we do have to keep in mind with this company is that they do not report in quarters, they actually report in halves of the years. So as we can see in the valuation ratios, they have half 2 2022, half 1 2023. This is because it's a European company, meaning that they don't have to file all the same requirements that companies in the US have to. Just by looking at the valuation ratio, we can see that LVMH is right now trading at somewhere around where it has usually been trading, as their price to earnings ratio was somewhere at around 26 times, and the price to cash flow ratio was somewhere around 19 times, which is around the average it has been trading for the past 2 years. Now, the good thing about this company is that it has managed to grow its dividend at an impressive 29.4% 3-year CAGR, and it is currently paying a 2.04% dividend yield, which is extremely attractive for such an established company. And now when we look at the revenue and income evolution, this company has been extremely stable. Of course, in the most recent half, we did see that weakness come in from China, which is part of the reason why the stock share actually plummeted. However, one positive thing to keep away from this is that their revenue declined, but their gross profit and net income actually stayed the same, meaning that their margins over the same time actually improved by a little bit, which we can see in the graph at the bottom left, where their margin evolution shows that it has been extremely consistent, but in the previous quarter it actually improved a little bit. Now, one thing I love about this company is their cash flow evolution. They are able to generate such consistent high cash flows and convert that into either share buybacks or their dividend in such an efficient manner. Now, in terms of leverage evolution, this company has almost double the total assets than their total liabilities, which is great as it allows us to assess that they're in a safe financial position. Now, stock number 2 is Humana Inc., which is in the health insurance industry. Now, this stock has been hit hard recently and is close to 30% down in the past year. Of course, if we look at their valuation ratios, their price to earnings ratio has actually risen a lot in Q2 2024, reaching almost 27 times, which has been caused by their earnings actually decreasing faster than their stock price has done. They do have a very solid 1.01% dividend yield, which I know it's not large, however, they have been increasing it at a pretty significant 12.3% 3-year CAGR. Now, when we look at the revenue and income evolution, we can see the main reason why I do not like to invest in insurance industry companies, which is the fact that they have extremely slim margins. You can see that, yeah, their revenue is huge. They're averaging around $30 billion in revenue per quarter. However, their gross profit and net income margins are so tight that even the slightest drop in demand can actually make their margins drop and go into negative territory, as it happened in Q4 2023. And now, this actually makes them not be a great candidate for our channel, as they're not especially efficient at generating free cash flows. Of course, if your company is generating very little net income and in various quarters it's actually coming up at a loss, that means that your company will not be able to sustain very high free cash flow generation. Now, however, when we look at their leverage evolution, their total assets are actually way above their total liabilities, which is a good trend. And we can see that over time they have reduced both total liabilities and total assets, which is actually improving their return on capital employed, which is allowing them to become more efficient in controlling their assets and making profits from them. Now, number 3 is Genuine Parts Company, which is in the automotive replacement parts industry. And as we can see, in the past year, it has dropped by close to 13%. Now, this company usually trades at a pretty small valuation because they're not a fast grower company. In the previous quarter, you can see that their PE ratio was around 16 times, which is roughly in line with the past year, and their price to cash flow ratio is around 12 times. Now, they do have a very juicy 2.84% dividend yield, which has been growing at an okay 6.3% 3-year CAGR, which is beating inflation and is actually rewarding the investors and shareholders of this company. And the positive thing here is that it has not had any bad quarters recently. As you can see, in Q2 2024, revenue went up, gross profit stayed more or less constant, and net income actually improved a little bit. This means that their margins have actually stayed extremely solid, very sustainable, very stable. Now, when we look at the free cash flow evolution, this company is able to generate consistent, stable, and predictable cash flows, which is something incredible because it allows them to maintain that dividend, grow it at a solid rate, and then use whatever is left for share buyback programs, which is something that will reward the investors when compounded over time. And now finally, when looking at their leverage evolution, again, their total assets are above their total liabilities, which is something extremely positive. Now, stock number 4 is Canadian National Railway, ticker symbol CNI, and it is of course in the railway industry as its name suggests. In the past year is down over 4%, and as we can see for the valuation ratios, this company again is not a fast grower as it currently sustains a PE ratio of around 18 times. However, this PE ratio is below the average of the past year. However, when we're looking at their dividend, it has a very nice 2.15% dividend yield, which has been growing year after year at a 10% 3-year CAGR, which is an extremely nice way of rewarding investors over time. And now this company, of course, is extremely consistent and extremely predictable. We can see the revenue and income evolution has stayed super stable over the past 4 quarters, and its gross profit and net income have been at similar levels every single quarter. The only problem with this is that it is not a high growth stock as it's a very regulated industry and it has limited capacity. However, this does mean that their margins are extremely stable, their dividend will be extremely stable, and as we can see, their cash flow evolution and generation is extremely predictable, stable, and of course, we love to see this as it is a great way of allowing them to reward investors. Now finally, when looking at their leverage evolution, they're also at a very okay position as their total assets are above their total liabilities. I would like this company to reduce their total asset base and total liability base to get better efficiency ratios. However, we'll have to see what they do with this. And now last but not least, we have Comcast Corporation, which is ticker symbol CMCSA, and this is of course in the telecom industry. Their stock price has dropped over 16% in the past year, and its valuation is extremely low. Now, this company has been traded in extremely low valuations for a long time, and it currently yields a PE ratio of around 11 times and a price to cash flow ratio of around 7 times. This does pay one of the juiciest dividends we have seen today with a 3.07% dividend yield, which has been growing at an 8% 3-year CAGR. Very nice for a company that has fallen over 16% in 1 year. Now, when we look at the revenue and income evolution, initially, nothing seems off, as their total revenue, gross profit, and net income have been extremely consistent every single quarter. Nothing has dropped, nothing has decreased significantly. And when we look at their margins, in fact, since Q4 2023 all the way up to Q2 2024, their margins have actually increased and the situation of this company has improved. Now, when we look at their free cash flow generation as well, it is extremely stable. It's generating extremely high free cash flows, allowing it to pay its dividend and buy back some shares. And it's also maintaining its solid financial position with its total assets being above its total liabilities. So this could be a very interesting company to investigate further. Now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. And having said that, thank you for watching. As always, this has been the Cashflow Compounder. Please join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.